Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. One of the questions that is running in everybody's mind is when US and Iran war is going to get over. But when the war started, US assumed that it is going to capture Iran in just few days. But Trump misjudged it. It is not Venezuela which is going to get captured so easily. My expectation is that the war is going to get prolonged for few weeks or months. In today's presentation, let us understand why. Second, what impact it is going to have on global currencies. Now let us understand why the war can get prolonged. First advantage on the Iran side is cost advantage. There is no doubt that US military is superior as compared to Iran, but US is using an expensive mode of fighting war against Iran. In the first 100 hours, US have already spent close to $3.7 billion. Let me give you a perspective. For example, US is using a very expensive missile interception system which is costing them $44 million per interception, while Iran is spending just 20,000 to $2 million per down oil missile. It gives a clear cut indication that Iran can last the war for a longer period of time. Geography location also favors Iran. Large mountain territory, many underground military facilities, and proximity to the war is an advantage to Iran, while US is fighting war far distance from its place. Third strategy of Iran is war of attrition. Iran clearly knows that they cannot defeat US in terms of the military size or operation. What strategy they are using? They are using that the war can get prolonged for a larger period of time, which will make US and its allies weaker in terms of economical, political power. If the war is getting prolonged, it is going to have negative impact on oil and energy prices. If oil and energy prices are moving higher, what impact it is going to have on global currencies? Let us understand that. Let us go back to history. In 2022, when Russia-Ukraine war started, euro got weaker by 14% and rupee also got weaker. Now let us understand where are these currencies moving in few months. If you see the chart, in Europe, energy gas prices have moved drastically in last couple of weeks. From 30 euro, it has moved to 50 euro per MWH. According to ECB, if the prices are increasing by 14% on a sustainable basis, then their GDP is going to reduce by 0.1% and inflation is going to come back or increase by 0.5%. Now let me give you another interesting data point. If you see the chart, it is very clearly visible that European gas reserves is at a multi-year low. From an average of 41%, their currently reserve is at 22 to 27%. Exactly similar thing happened when Russia-Ukraine war started. So basically, Europe is the country which can be hurt the most if the crisis get prolonged. So now the question is, where is Euro USD moving? For Euro USD, 1.1650 and 1.17 is going to act as a very strong resistance. There is 90 to 95% probability that euro can move towards 1.13 kind of levels in couple of weeks time. Now let us understand what is the outlook on dollar index. Last week when dollar index was trading near 97.5 kind of a level, we suggested that dollar index is likely to move towards 100.50 to 102 kind of a level. The view for dollar index remains same, that dollar index can move higher towards 100.50 to 102 kind of levels. Now let us discuss outlook on rupee. Let us first start with RBI's strategy. When dollar rupee pair was trading close to 92 kind of a level, we have seen that on Thursday morning RBI intervened strongly and rupee opened near 91.50 kind of levels. According to Reuters, RBI must have sold close to $12 billion to ensure that excessive volatility in dollar rupee pair is curbed, and the pair was able to move from 92 plus levels to 91 and a half levels. So despite RBI intervening strongly, our view is that rupee might depreciate further. Let us understand why. Rising oil and natural gas prices is going to have an adverse impact on our economy. Any rise close to $10 per barrel is going to increase our trade deficit close to 13 to 15 billion dollars per year. Our current account deficit is going to increase by 0.3 to 0.5% of GDP. Our GDP can fall by 0.20 to 0.50 percentage. Second negative point can be FIIs can continuously sell in Indian equity market. After the war has started, FIIs have sold close to 21,000 crore from Indian equity market. Third negative point for rupee can be stronger dollar index and rising 10-year US yield. Because of all of the above reason, we feel that 9140 to 9150 is going to act as a very strong support for the pair, and the pair is likely to move towards 92 and 92 and a half kind of levels in coming days. Now let us discuss strategy for thin margin exporters like agri exporter or a chemical exporter. Most of them have taken costing close to 91.20 to 91 and a half kind of a level. To them, we will suggest that 60 to 70% of their exposure they can cover between 91.80 to 92.10 kind of level. Between 90 to 20 to 90 to 50 kind of level, they can increase their hedge ratio from 70% to 80%. Above 90 to 50, they can increase their hedge ratio and then they can take the hedge ratio from 81% to 100%. For the entire strategy, the stop loss remains 91.50 or costing, whichever is higher. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporter. For them, the strategy is very simple. Keep a stop loss of 91.50 and wait for higher levels of 92 and a half. Let us discuss strategy for importers. From last few weeks, we have been suggesting importers at every level they should cover their imports for next 45 to 50 days. In case anyone has not been able to cover at lower levels, for them we will suggest that they should keep a stop loss of 92.05, and any level towards 91.70 to 91.80 should be taken as an opportunity to cover imports for next 45 to 50 days. With this, I will end my today's presentation. Jai Hind, नमस्कार, फिर मिलेंगे next week. Thank you.